Welcome to Section 4 of the Payroll and Workforce Cycle Training for P&J Group. This section covers three areas that sit at the heart of payroll integrity: the accounting entries that record every payroll event, the internal controls that prevent errors and fraud, and the risk register that shows what happens when those controls fail. Whether you work in HR, finance, or operations, understanding these three layers is essential for keeping the organization protected and compliant. By the end of this section, you will be able to do 5 things. First, record the 6 core payroll journal entries correctly. Second, distinguish between preventive controls, which stop problems before they start, and detective controls, which catch them after the fact. Third, identify the highest risk payroll exposures and what they cost the organization. Fourth, use the key performance indicators that signal payroll health. And fifth, recognize the specific control failures that open the door to fraud and compliance violations. The first and most important journal entry happens every pay period when gross payroll is expensed and all related liabilities are recorded. The debit goes to salaries and wages expense, broken out by department. The credits go to every liability that payroll creates: federal income tax withholding payable, FICA payable for the employee share of Social Security and Medicare, state and local tax withholding payable, benefits deductions payable covering health, dental, and 401(k) employee contributions, garnishments payable if applicable, and finally the net pay due to employees through the payroll bank account. This single entry captures the full cost of the payroll and every obligation the company owes on behalf of its employees. Entry 2 records the employer's own share of payroll taxes. The debit is to payroll tax expense, and the credits go to 3 payables: FICA payable for the employer's matching share of Social Security and Medicare, FUTA payable for federal unemployment, and SUTA payable for state unemployment. Entry 3 records the actual cash payment when tax deposits are remitted. All of the payable balances built up in entries 1 and 2, federal withholding, both shares of FICA, and unemployment taxes, are debited and cleared, with the credit going to cash through EFTPS or the state deposit system. Timely execution of Entry 3 is critical. Late deposits trigger penalties ranging from 2 to 15%. Entry 4 records the remittance of benefit premiums to the insurance carrier. The debit clears the benefits deductions payable account, and the credit reduces cash. Entry 5 handles workers' compensation. Each pay period, an estimated premium is accrued by debiting workers' compensation expense and crediting workers' compensation premium payable. At the annual audit, the actual premium is compared to what was accrued, and a true-up adjustment is recorded to correct the difference. Entry 6 covers employee separations. Final wages are debited to salaries and wages expense. If the employee has earned PTO that must be paid out, the accrued PTO liability is debited to relieve that balance. Both credits go to the payroll bank account as net pay. Preventive controls are designed to make errors and fraud impossible before they occur. No one may be hired without assigned position authorization and a confirmed budget. Before any out-of-state hire is onboarded, a state nexus check must be completed. I-9 documentation must be done by day 1, and the new hire reported to the state within the required window. W-4s must be entered before the first payroll run. New employee setup requires dual review before the record is marked active. Pay rate changes require written authorization from both HR and finance. No verbal approvals are accepted. The payroll register is locked after the finance director approves it. Any qualifying event triggers the COBRA checklist within 14 days, and termination notices must be sent to payroll in writing, same day, with named sender and recipient on record. Detective controls run after the fact to catch anything that slipped past preventive measures. Before every payroll approval, a period-over-period variance analysis is mandatory. Unexplained changes must be resolved before the run proceeds. Headcount is reconciled between the payroll system and the HR active list every single pay period. A terminated employee check is documented before every run. Tax deposit deadlines are tracked on a calendar with confirmation receipts. The 401k remittance is confirmed within 7 business days of each payroll, as required by the Department of Labor. Health insurance premiums are reconciled to carrier invoices monthly. Workers' comp accruals are reconciled to carrier invoices annually. PTO liability is reconciled to HR balance records monthly. The payroll bank account is reconciled to the bank statement monthly. Pay rates are audited against authorized HR records quarterly. And once a year, management conducts an unannounced surprise audit of the full payroll register. The risk register begins with the 2 most severe fraud exposures. A ghost employee is created when someone sets up a fake employee in the system and routes payments to themselves. This risk is rated high because it can run undetected for years and produces direct, ongoing cash loss. The root cause is a missing dual review on employee setup and the absence of headcount reconciliation. Equally serious is payroll approved by only one person. When there is no independent reviewer, errors and fraud go undetected. These 2 risks are directly connected. The ghost employee risk is nearly eliminated when dual setup review and headcount reconciliation are both in place. 3 more high-rated risks center on tax obligations. Missing a federal or state tax deposit deadline is high risk because penalties range from 2 to 15%, and in the most severe cases, responsible officers face the trust fund recovery penalty, which is personal liability for unpaid trust fund taxes. Running payroll in a state where the company is not registered is also high risk. It triggers penalties, retroactive registration requirements, and potential refiling of prior periods. Late 401k remittance is a separate high risk. The Department of Labor requires deferrals to be remitted within 7 business days. Failure is a prohibited transaction, subject to excise tax and requiring formal plan correction. Each of these is a control failure, with direct financial and legal consequences. 3 final high-rated risks involve employee separations. Final paycheck noncompliance occurs when a company uses its regular pay cycle instead of meeting the state law deadline for the final check. Depending on the state, this triggers waiting time penalties, wage claims, and Department of Labor investigations. COBRA notice failure happens when the notice is not issued within the required window after a qualifying event. The federal penalty accrues per day, per beneficiary, and can accumulate for months before it is discovered. And payment after termination occurs when payroll is not notified of a separation before the payroll cutoff. A salary payment goes to a former employee, and recovery of those funds is uncertain. All 3 trace back to the same root cause: a breakdown in timely, written communication at the point of separation. 4 medium-level risks round out the register. FLSA misclassification, treating a non-exempt employee as exempt and not paying overtime, carries back pay exposure and class action risk. Workers' comp premium understatement happens when job classification codes are not updated as roles change, resulting in a large true-up bill at the annual audit. Garnishment errors, where the wrong percentage is applied, make the company liable for any shortfall. And PTO liability understatement, caused by failing to post accruals each period, understates the balance sheet and creates disputes at separation. The KPI table ties directly to these risks. Payroll accuracy rate, on-time payroll rate, headcount variance, tax deposit compliance rate, 401k remittance timeliness, Nexus check completion, I-9 and W-4 completion, final paycheck compliance, and COBRA notice compliance are all measured every pay period or per event. Monthly metrics track payroll cost as a percentage of revenue and PTO liability trends. The workers' comp audit accuracy is tracked annually. Every control in the register exists to address a specific risk. Dual review on employee setup directly prevents ghost employees. The terminated employee check before every run prevents payment after separation. The period-over-period variance analysis catches unexplained changes that could indicate either fraud or processing errors. The tax deposit calendar with confirmation tracking prevents missed deadlines. The 401(k) remittance confirmation within 7 business days prevents DOL violations. The state nexus check prevents unauthorized state registrations. COBRA checklists triggered within 14 days prevent notice failures. The pattern is consistent. Each high-rated risk has a corresponding preventive or detective control, and the KPI for each measures whether that control is actually working. Here are the key takeaways from Section 4. 6 journal entries cover every payroll event from the initial gross expense through tax deposits, benefits remittances, workers' comp accruals, and final pay at separation. Preventive controls stop problems before they start. Detective controls catch what gets through. Ghost employees, missed tax deposits, and late remittances are the highest consequence risks in the register. Every high-rated risk has a direct control designed to address it, and the KPIs confirm whether those controls are actually functioning. Finally, 3 separate high-rated risks, final paycheck noncompliance, COBRA failures, and payment after termination, are all prevented by the same thing: timely, written communication when an employee separates. In Section 5, we move to the independent contractor process.